Hi everyone. The last month witnessed a shift from calmness to turbulence in the bond market. The conflict in Iran led to heightened volatility, with bond yields rising more than 30 bips within just a fortnight towards the end of March. The escalation in the Middle East primarily affected crude oil prices, which in turn impacted on the INR, leading to the expectation of a higher current account deficit. This chain of events influenced the bond yields, driven by expectation of higher inflation and a rising fiscal deficit. However, in April, a tentative ceasefire between US and Iran caused oil price to drop sharply, providing some respite to the bond yields, which eased by 20 bips. On the other hand, the RBI monetary policy saw no change in the rates, no shift in the stance, and no additional liquidity measures. The RBI governor maintained a well-balanced commentary, carefully weighing inflation risks against the GDP growth. The RBI revised financial year 2027 inflation forecast upward to 4.6% year-on-year, while lowering the GDP growth forecast to 6.9%. In an environment where shocks are increasingly geopolitical, non-linear, and hard to model, the forward trajectory of markets remains difficult to predict and must be finely managed. Overall, we expect the 10-year Indian government bond yields to trade in a broad range of 6.70% to 7.20%, depending on the evolution of conflict and the repercussion on the macroeconomic factors.
Hello everyone. If you look at Indian equity markets over the last 1 month, one theme stands out: geopolitics. US-Iran related tensions dictated market directions far more than fundamentals. The escalation in the Middle East, particularly around key oil and gas supply routes, pushed energy, including crude and gas prices, higher, and that had a direct impact on the Indian equity markets. The biggest pressure was seen in oil-sensitive sectors. Paint companies, aviation, and auto stocks came under stress due to the rising input costs. OMCs also remain volatile as higher crude complicates margin outlooks. Financials remained under pressure as rising global uncertainty and higher bond yields kept FII flows volatile, while fears of inflation, a potential economic slowdown, and asset quality risks further weighed on sentiment. On the macro side, the ripple effects were visible: a weaker rupee, rising bond yields, and some pickup in inflation expectations. All of this kept broader market sentiment negative, while domestic macros like GST collection and fiscal progress remained strong. Global uncertainty and FII flows kept markets under pressure. At the same time, we saw defensive sectors outperform. IT held relatively steady, supported by currency depreciation, and pharma saw selective interest as investors looked for stability. A 2-week ceasefire has been agreed upon by US and Iran. Now the important question is, what happens if tensions ease in the near term? Historically, when oil cools off, the biggest beneficiaries are the same sectors that got hit. Consumption-linked names like paints and autos tend to bounce back. Aviation recovers on margin relief, and broader cyclical regains momentum. Financials could also see renewed interest as flows return and macro stability becomes the focus again. So, the key takeaway is, the last month was less about the earnings and more about external shocks. But markets don't wait for perfect clarity. And historically, the biggest wealth over the long term has been created by investing during times of stress like these. Thank you.